Hello, everybody. Welcome to this webinar brought to you by Macquarie Warrants Malaysia. Today, we are very excited to be hosting this session that is titled Technical Analysis, Techniques for Stocks and Structured Warrant Trading. So my name is Yong Chee. I'm the moderator for this session. So in this webinar, our speakers will share with you their unique strategies to trade the markets, whether it is in swing trading, whether it is in breakout trading, or whether it is momentum trading. So today they will lay bare their strategies on how do they profit from the market, right? And of course, we will also learn about what exactly are structured warrants and how you can use it to complement your trading strategies. Now, before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're 100% responsible for all your investment risk. All right, cool. Okay, so allow me to briefly introduce our first speaker. So this session will have two speakers here. So each one will take an hour time. So our first speaker is none other than Mr. YC Chin. So YC is the founder and chief trainer for Shareware Consulting. He is also a dealer rep with TA Securities. Now, he applied technical analysis in his trading, mainly focusing on share movement analysis, price volume analysis, indicator, candlestick formation to observe the buying interest and selling pressure and further justify the key supports and resistance level. So his forte is in understanding the movement of buyer and seller through the distribution area of banker chips. YC is also a regular speaker for a number of financial institutions to train their clients in trading. They include Kenanga Investment Bank, Macquarie Capital Securities, Malacca Securities, and TA Securities. He was also invited to speak for Investing Note and SGX, as well as other tertiary educational institutions such as UTAR, RUMT, and UUM. Having 13 years of market experience, he had trained more than 2,000 students with his trading strategy from 2019 to 2021. So academy-wise, he completed certificate and professional level from Institute of Chartered Accountants in England and Wales. He also passed level 1 of Chartered Financial Analyst. So let's welcome YC. So YC, good morning. How are you today?
Hey, morning. Hey, thank you everyone for spending your time attending this event. Understand that recently the market is not good. Okay, so it's good that all of us here to learn together. So let me share my slide.
Yes, we are looking at your slide right now.
Okay, cool. Okay, so first of all, disclaimer first. Okay, all of the information shared today is just for the educational purpose. It's not for any buy or sell call. Okay. Uh, Basically is that we aim for the earn and learn together because we will share all those techniques, all those breakout techniques. So basically it will link to some of the case study, but it's not any buy or sell call. We will use those case study that we really spotted the entry point that we really traded before. So let's start. Okay, this one basically is my background. Just now already, we already talked about it. Basically, is that I started with the FA also because I'm from the financial background. But after that, I feel that in Bursa, if we trade the stock in Bursa, we have to apply also the technical analysis in order to spot the better entry point. Okay, so my first topic is that how to trade a breakout, then followed by how to ride with trend and also selling pressure and buying force, and how to spot the flow of fund. Basically, it's the smart money, hot money. Okay, then we will go to the case study part. For the case study, I will show quite a lot of case study in order for all of us to learn the techniques. Okay. So how to trade a breakout? Breakout trading basically is that when the price it breaks the resistance zone, then with the increased volume, this is the point that we should pay attention to. It means that the buying interest is raising, the momentum is getting huge. It means that the buyer is coming in. Okay, the buyer is coming in. Okay, why we prefer a breakout trade? Because if we trade sideways counter, if we enter those downtrend counter, okay, it will take us a lot of time to wait for it to go up in price. Okay. However, if we trade the breakout counter, it means that the stock already picking up, the momentum already being picking up. Okay. It means that like instead of we wait for the bus to come at the bus station, now it's that okay, we go to the bus station when the bus is about to come. Okay, it's that we can save a lot of time waiting for the bus to come. Okay, it's for the fund efficiency, it's for the time management. Okay, so basically is that for the breakout strategy, it will give us a better return because the momentum already come. Then we jump in. Okay, as simple as this. Okay, so basically we will share a few types of the breakout. Actually, breakout got a lot of types. Then we will cover the box breakout and also the triangle breakout today. Then in our case study later on, all of the technique that we share now, everything will link there. Okay, it's the actual strategy that we are using. Okay, so basically for the box breakout, it means that usually the stock is trending in a certain range. Okay, in a box range, in a certain range. Okay, then whenever it break out above the resistance, or it break down above the support, it means that the stock already chosen the direction for us. Okay, so sometimes is that this stock, okay, it has good project, it announced a very good announcement, getting project, okay, maybe disposal of those assets, getting back a lot of cash, this and that, or they report a good quarter report. Okay, a lot of news, but how the market react to the news is another matter. Okay, sometimes we will realize that most of the time, okay, a stock, it posted a good QR, but it will eventually still get down. Okay, the price will go down. Okay, sometimes it posts a bad news, but the price will go up. So it's like very confusing. But no matter how, if we follow the price movement, so it will give us a direction. It means that the market, most of the market people, okay, most probably is the smart money. We call it hot money, smart money. Okay, consists of those institutional people or those insider people. Okay, maybe they know more than us. So sometimes when posted a good news, but they know something is happening, something bad is happening, so they sell on news, sell on the good news. Okay, no matter how, the stock already chosen a direction for us. Okay, it go down or it go up, so we just follow. Okay, we as a trader, we just follow the trend. We just follow the movement. We just follow the momentum. Okay, because we cannot fight against the market. Like for example, recently the market is very bad. Okay, so when it break the support, as a trader, when it breaks the support, then we have to exit. We have to exit. Okay, probably let's say we exit. Okay, 1 day earlier or 2 days earlier, we make losses also because cannot 100% be winning one, but we take small losses. Okay, if when it break the support, we still don't want to cut loss, we still has got a fake hope, then you will see for the past 2 days the stock price probably from -5% to -10% to -20%. So the losses were getting bigger and bigger. So we will be very difficult to handle the risk in this case. Okay, no matter how, we just follow the market. The market has chosen direction for us. Recently, means that when it -5% means that the people already start throwing. Okay, it already start breaking down the support. So we cannot fight against the market. We just follow the market. We exit first. Then we wait for the situation to be more stable, probably next week. Next Monday, probably another sell down. Okay, so we wait for the sell down, those penny sell down. Okay, everything comes in first. Then we wait for the situation to get stable. then we will plan for the re-entry. This will be a better risk management case. Okay, we just follow the market. Like in this case, you can see there is this one is a bigger picture of the Inari, bigger picture because it is a few months chart, few months movement chart. Okay, so we can see when it breaks out a zone, okay, a box zone, basically it's a yellow color zone. Okay, it will go to another zone. Another zone, it will form another box zone, meaning the stock price trending, okay, within this zone. Okay, then it breaks out, okay, to another zone. It's like this, okay, one zone to another zone. So we can refer this. After we see the case study, we'll refer back to this slide. You can see when it breaks out, then the breakout zone, the resistance become the new support. The resistance become the new support. Like in this case, when it breaks out, then the earlier breakout zone will be the support. It shouldn't drop below the support zone. Then it will trend, it will take some time because this one is we call it a bigger cap stock. So it will take more time, okay, to form the overall movement. Then it will go to another zone. Like this. This one is a box, okay? Box to the box zone. Okay. So the other breakout that we're gonna share today is the triangle breakout. Okay, triangle breakout basically is the downtrend line breakout. Okay, it consists of two lines. Okay, one is the uptrend line, one is the downtrend line. Okay, we can see that the zone is getting smaller and smaller. Means that the stock is about to choose a direction. Same as just now the box theory. Okay, the box. Okay, when it chooses direction, means that it go up above the zone or it go down below the zone. Okay, same as the triangle breakout. Okay, when the zone is getting smaller and smaller, tighter, then one day it will choose the direction for us. We don't need to, you know, think ourselves. Okay, we don't need to make assumption ourselves. We just follow the market. Okay, because we have to believe that among the stock market player, there are a lot of people smarter than us. Hot money, we call it hot money. Okay, be it insider people or institutional people or fund, they know more info than us. Okay, they can visit the company, they can meet the company management to know more of the company. So they always get a first-hand news. So no matter how, most of us is the retail investor, be it retail normal investor or retail high net worth investor. We are retailer. Okay, so how are we going to get the first-hand news? We can only spot through the chart movement. Like for example, a fund, an institutional fund, okay, or insider people, they know certain news going to happen to this company, going to happen to this share, okay? So they buy. When they buy, when those funds start buying, okay, the stock price going out. When the stock price going out, it will form the breakout. It will form the breakout. Then we can know that something is happening to this stock. This is how we also get the so-called first-hand news through the chart movement. Okay, because we have to understand that we are retailer, so we have to, you know, through the chart movement, we at least can also tag along with those like hot money. Okay, so in this triangle breakout case, when the stock price, the zone is getting tighter, then it will choose direction for us. When it breaks above the downtrend line, okay, the downtrend line, it means that it already break out the resistance. Okay, it already break out the resistance. So we just follow along. Okay, so when the stock breaks down the support line, the uptrend support line, so this counter we most likely we no longer will be seeing it because it has chosen direction for us. Okay, no matter whether it has posted good QR or how, as long as it has already chosen the direction for us, we will just skip first. Okay, until it show a good setup in the chart again. So we will reconsider. Okay, so this is another example. This one is just a basic example. In a more detailed example, we will share in the case study part. Okay, so you can see basically this one is a very obvious triangle zone. So how do we draw the zone? We connect the dots. We connect the high to high. We connect the low to low. So the low to low will form an uptrend line. The uptrend line is the support. Like I shared just now, is a support. So whenever the stock breaks below the support, we will no longer be seeing it. Okay, because in Bursa, basically, how are we going to win? We buy low, sell high. It's really difficult for us to sell high, buy low as in short. Okay, so when the stock price breaks down, so we will just skip. We will just skip. Okay, in the foreign market, when the stock price breaks down, they can short. Okay, but in Bursa, we're talking about Bursa. Okay, most of the winning strategy is buy low, sell high. So when the stock price already breaks down, so we no longer be seeing it because not good, cannot go out. Okay, as simple as that. So when a stock it breaks out the downtrend line. Okay, the downtrend line is that we connecting the high to high. High to high is the resistance. Okay, so when a stock breaks out the resistance line, so this one is that we can know that it potentially it's not 100%. Okay, every time when we share the knowledge, every time when we doing webinar sharing, educational sharing, okay, be it to the university student or the institutional client, we will always be reminding that there's no 100% in stock market, even though through technical analysis. It's all about probability lah. Okay, is that okay? When a stock breaks above the resistance, we can know that higher chance this stock is going out in the near future. Higher chance, more probability. We cannot say that 100% it will be going out. It's all about probability. It's all about risk management. The same as when a stock breaks down the support, we cannot 100% say, oh, it wouldn't go out anymore. We can just say that, oh, higher chance is facing the resistance. Higher chance got people selling. Okay, so in short term, we wouldn't be seeing it. Okay, so next we will be sharing how to ride with trend. Okay, first of all, you have to understand the types of the trend. Basically, it's the uptrend, sideways, and also the downtrend. So if you all remember, just how in the starting of the webinar, we have shared that basically we should avoid downtrend counter, sideways counter, and we only focus on uptrend counter. The reason being that for the uptrend counter, even though you buy a little bit higher, okay? Later we got a lot of real life case study we can see in the later part. Okay, but overall is that in the uptrend counter, even though you buy a little bit higher, you still got better chance to earn, because when it go out, it will retrace. Okay, it pump out one day, it will retrace 2 days, 3 days. Okay, then it will pump again. Okay, so we can see this chart. Okay, this one is a very basic uptrend. So you can see the thing is that it continuously going out. Okay, after we call it healthy retracement. Okay, but for the sideways, like we mentioned just now, it will take us a lot of time. The sideways is like the box theory that we share. It's trading in within the box. What you can do is that you can only buy when the stock price reaches the bottom of the box zone. Then you sell when it reaches the top of the box zone. But the money that we can earn is very minimal, because it's not breakout, it's just like sideways within this zone. Okay, like 1 ringgit to 1 ringgit and 10 within this zone. Okay, so if one day you buy at the bottom of the box zone, but suddenly it breaks down, then your risk will be higher. So might as well we wait for it to confirm breakout, we go for the uptrend stop. Okay, so this one sideways we will also skip. Then for the downtrend one, we will confirm skip, unless you are a very high risk player. Because sometimes later I will show a case also, Toyo recently one. It's also a downtrend stock, but it rebounded. Okay, so all this kind of downtrend stock, if you are a holder, you are not a trader. If you are a holder, you don't want to see the market one. You have no time to see the market one. Okay, basically you can just avoid, because if it rebounded but you don't have the time to monitor, or you didn't set the stop profit zone, so after it rebounded, it will go down again and go down further. Then probably you will make losses. Your risk will be higher. So for we call it normal people, it's not the full-time trader. So usually we will ask them to skip the downtrend stock. It's better lah, okay, for the risk purpose. Okay, unless you got the time to monitor. Okay, and you know that this one is the high risk counter. You just want to, play a small portion, then okay. Overall, you just focus on the uptrend counter. Okay, for example, let's say a lot of people, they want to buy on dip. Okay, when the stock price started coming down, they think that it's cheap. They think that it's cheap. Okay, in the fundamental perspective, probably is not wrong. Just that if a stock suddenly it get down a lot, it means that something is happening, be it due to market sentiment, be it due to some news that we not known yet. It has something happening. So we usually we just skip. Okay, for those, like we call it bottom catching. Okay, unless you are a very short-term player. Okay. So usually for those uptrend counter, when it breaks above the resistance, although you can see the price already go up a lot. Okay, it's already go up a lot, but it still has higher probability, higher chance that you can still make money. Okay, it's all about probability, no 100%, all about probability. Okay, so overall, the trend is our friend. Okay, we just follow on trend. So since many years ago, whenever we share those knowledge to people, share those info to people, we will ask them, most of the people, they're suitable to aim for those uptrend stock. Because uptrend stock, even though it retraces, you buy a little bit higher, it retraces, but it has higher chance that it will continue to go back up. Higher chance. But for those downtrend one, you buy, you hold. The longer you hold, the more your losses will be, because it will rebound, then go down further. Rebound a bit, then go down further. And the fact is that whenever it rebounded, people wouldn't want to sell, because they feel like, okay, a little bit more to my cost, so I will just wait first. Then whenever you wait, then it will go down further. Then you will start there. Okay, so overall, just remember that we focus on those uptrend counter. Okay, so the next part is that we will be sharing about the selling pressure and the buying force. Okay, so you can see just how we have already learned the box breakout, Okay, so in this part, we can know in detail that the box breakout, just how we mentioned, the top of the box, the bottom of the box. Basically, it means that is the support and the resistance. The support and the resistance. Okay, the support means that the buying force. The support means that demand. Okay, as simple as that. Support. Why the stock price will be supported at the price? Because demand comes in. Demand comes in, buyer comes in. Okay, more people think that this price is a good price, a reasonable price. Okay, a safe price for them to enter. So more of the buyer at the zone to buy. And at the zone, the seller think that, okay, this price is too cheap for me to sell. Okay, I don't want to sell anymore. So the seller also reduce. So the price is the demand zone overall. And for the resistance zone, it means that selling pressure zone. Okay, lesser people want to buy at the zone. More people want to sell at the zone because they feel that, okay, I have already gotten a lot of profit there. They feel that this one is the trap zone, means that earlier got people trapped at this price. Okay, so when it goes back to their cost, those trapped retailer, they want to break even, so they will sell at that price. Okay, like probably some of the people, they will be holding their stock for 1 year, 6 months, 2 years. Okay, so when the stock price goes back up, then they will sell in a minimum profit or sell to break even. But along the way, 2 years time of holding, 6 months time of holding, probably their paper loss is 30%, 40%. They don't want to sell one. So they just wait until one day, the stock price bounce back. Then they will sell to break even, although they already kind of like, wasted 2 years time, 3 years time. Okay for them. This is how we call retailer, what they do, usually what they do lah. Okay, so at that zone, there's the resistance zone, because when the stock price go back up, people want to sell. Okay, so how do we like determine where is the resistance, where is the support? Basically, it's the most touches point. Okay, is that connect high to high, the same as the triangle breakout strategy. You connect the high to high. The high to high is the resistance. Okay, as like you can see from the chart, The high to high is the horizontal resistance, okay, the high point, okay? And the low to low is the support zone, okay? It's the support zone, okay? So after understanding all this, so let's think back. Just how we mentioned that box breakout, we talk about breakout. So why breakout is important? Like we can imagine, just how like what I shared. Resistance is the price where the selling pressure comes in. A lot of people want to sell. Okay, that's why it will go down. The stop price will go down because a lot of people want to sell. So let's imagine, one day, okay, one day, the supply zone means that the selling pressure zone, it got breakout. What does it mean? It means that all along the time, this price is the resistance price. In the market, most of the people think that this price is the high point already. They want to sell. They feel that no longer can go up, so they want to sell. So we can imagine that one day, the buyer at this resistance zone is more than the seller. Like a lot of people want to sell, but in fact, more and more people want to buy. So this is the change of structure. Means that things already changed. Okay, like something is happening, but we don't know what is happening. Probably due to good news coming soon, probably due to getting good project, they are posting good earnings, a lot of news. Maybe fund is coming in, boss is buying, a company doing share buyback, a lot of different reasons. We don't know. And we wouldn't know at that moment. Probably we will know after a few days' time. But what we're going to do is that we have to react according to that market situation. When the price breaks out above the resistance, it means that something is happening. It means that suddenly buyer is more than seller at that particular resistance point. So that's the point that we should take note. This is how the breakout works. Okay. So in short, it means that whenever the price it breaks above the resistance, basically it will become the support. So let's think back the box strategy that we shared just now. Okay, it's from one zone to another zone, box to box, like just as same like this chart. Okay, when the support break down, it will become the new resistance. Okay, so basically is that a zone to a zone. If it breaks out, then it will become a support. If it breaks down, it will become a resistance. Okay, basically it's the supply and demand, like we mentioned just now. The supply zone means that resistance. Okay, resistance zone. Demand zone means that the support zone. So whenever it breaks above, basically it's the change of structure. It breaks the structure already. Okay, it breaks the earlier structure. Earlier, the price is trading along this way, inside within the zone. Okay, until one day it breaks above. The structure already changed. The structure already different. Okay, and also we can see from this slide, we can see that for the uptrend counter, basically you buy. Let's say if you buy at a high point, okay, it will retrace. Usually it will retrace because the stock price cannot be continue every day go out without retracement one. So reasonably thinking, a healthy retracement, we can expect it is okay one. So you can see from the left-hand side, the uptrend stock, after it retraces, it can continuously go out. Retrace, go out, retrace and go out. This is what we shared just now. Okay? Continuously, it will go out, even though you buy a little bit higher. In terms of probability, in terms of the, we call it the winning ratio, okay? You will have better chance of winning. Okay, and you see the right-hand side. The one is, let's say if you buy a downtrend stock, okay? You think that you buy at a cheap price already. After it rebounded, usually it will rebound a bit lah, okay? It rebounded a bit, you don't want to realize the profit. You continue holding. Then you go down further. Okay, then you feel that, okay, you already made losses, you don't want to sell. Then you continue hold. Then it rebounded back to your cost. Usually people also don't want to sell one. This is the psychological part of the, market player. They don't like to realize the loss, or they don't even like to break even, because they feel that if I break even, I will lose the brokerage charge, the brokerage part. Okay, they will think about that part. Okay, so they continue holding. They feel like, okay, give me 1 or 2 bids more, 3 bids more, so that, okay, I can exit with slight profit. But if you continue holding to those downtrend counter, usually it will continue go down further. Like you can see from the right-hand side, the slide. Okay, one is the downtrend one is the uptrend one, and you can see basically supply is the resistance. Okay, support is the demand zone. Okay, so we go to the next point is the how to spot the flow of fund. Okay, flow of fund. So basically, flow of fund, it means that hot money and also the smart money. Okay, so overall is that what is hot money? Actually, everybody can be hot money, just that you know, as long as you aim for the short-term returns. Okay, some of the hot money could be fun. Okay, they feel like, okay, currently the trend is the AI trend. Currently the trend is the data center trend. Okay, or construction trend, property trend. Okay, so those big company like those construction one, property one is very heavy. Okay, if you're looking back for the past few years, all those counter is very heavy. We call it heavy. So usually in the past few years, you wouldn't be trading those property or those, especially construction. Property still sometimes okay. Construction counter is very, very heavy one. Okay, so only until like this year or end of last year. So this sector, this type of sectors, they start attracting those funds. So hot money means that those smart money, okay, they know that okay, currently what is the team going on. Sometimes the team is very short one, like those AI one, data center one, considered very long already. But if you're looking back past few years, basically like every 2 months, every 3 months, it will come a new team, be it a short one or a long one. Like sometimes we call it penny stock team also got like it will go up or active, we call it active for 2 weeks time, 3 weeks time. All those like penny stock also it will come. Okay, but those like construction property one due to Johor, you know, those quite long, like 6 months, 1 year already. Okay, basically the one is longer period. So overall is that those hot money, they can spot what is the team, what is the opportunity coming in the market. Okay, like recently, basically if you are active market player, you can notice that some of the counter, they're doing the share consolidation. Okay, those very penny stock, actually a lot, X, okay, also Bpuri, if I'm mistaken, and also the recent one is SOX. Okay, basically all these type, the share consolidation type is actually also a team, but it's very little team. So you wouldn't be hearing people out there talking about it. But for us as trader, we can spot all these teams because every time we will be screening through the system, screening through the filtering criteria, seeing what is the active counter. Then we can see basically active counter and active counter, they have the linkage one. Like recently, basically, like I mentioned, is the share console one. Right? As long as after they've done the share consolidation, so it will pump out. It will pump out, and we call it the room. Okay, the room is not little, quite a big room of the profit. Okay, so in the market, many different teams, many different teams. So the hot money is like they aim for those short-term returns. Okay, they see whenever opportunity arise, they will just go there. Okay, be it a solid team or just a short period of time team. Okay, different type of team. But for the smart money, basically it consists of those funds also, institutional fund, okay, those government fund, okay. So they know what is happening in the market. Okay, they will combine also, the economics thingy. Okay, so they think that probably okay, the property counter will be good, the construction company will be good because a lot of infrastructure project coming in, giving out by the government. So they will know, oh, this sector, okay, they should be looking into. Okay, and those data center one. Okay, so all this is that they have done their study. Then how are we going to ride along with them? It's like I shared just now. Is that basically if you see the breakout happen in certain stock, it means something is happening. Like, for example, if you all remember, like the WCT, okay, WCT, okay. So before it posted a news that, okay, it want to, you know, list the REITs, okay, arm of it. Before it posted the news, the stock price already going up a lot. If we wait for the news to come out, only we consider whether we want to make entry, it will be a little bit late in terms of the time frame. Okay. So if you focus on the strategy breakout, okay, even though you not going to buy it, not going to buy it, but as long as you can focus it, you will get a better sense than others. Okay, you buy it or not is another matters, but you can spot all those breakout counter. You know that, oh, this counter suddenly getting active, something is happening. So you will get an earlier sense than us than others. Okay. So another thing is the sector rotation. Sector rotation basically is like what we mentioned just now. Okay, it's quite the same as the team rotation. Sector rotation is rotate from a sector to another sector. Probably like, you know, like earlier when property stock coming, people will link those smart people. Okay, smart money, hot money, they will link. How they link? They feel that, okay, property coming, construction counter will coming. Construction coming, steel counter will be coming. Cement counter will be coming. Okay, you know, this is how they link and they react very fast, you know. Okay, so like this is the sector rotation. But for the team wise, got different type of team. Team can be what, you know, can be IPO team. IPO team. Because IPO is not a sector. IPO can be a team. Like earlier back in previous time, suddenly, like those recently listed IPO, they all started active. Then how are we going to spot all these, you know, not the sector one, is the team, okay? Those active in the team. How are we going to spot it? Is that, like I mentioned just now, you through filtering criteria, or you can see from the top active, you know, or maybe you have your own screening criteria. As long as you can focus on those active one, you can see, you can link, you can see their common characteristic, the similarity part. Okay, then you can know, oh, all this is the IPO that listed in 2022, back in 2023, you know, tiba-tiba, suddenly all of it getting active. Okay, and recently one probably, you know, Go Hub. Okay, Go Hub also you know, quite perform. But before Go Hub start to, you know, break out, okay, there's one time also three of them like UUE, Go Hub, and one more is the Ocean Fresh. Okay, because they listed quite the same time. So whenever a stock active, so the other will follow. Okay, but that one is during intraday. Okay, so that is the team part. There is the team part. Got the IPO team, penny stock team. Because penny stock is not a sector also. It's a team, like the share consolidation they are mentioned just now. It's not a sector. Share console is a corporate exercise. It's not a sector. Okay, so all this is the, you know, like you're gonna be following the hot money, following the smart money. Okay, you can spot, okay, which of the stocks start breaking up already. What is the common characteristic? So you can know what is the team coming. Okay, what is the sector coming for now. Okay, so for the sentiment analysis, okay, basically this one is I just added the right hand side one I just added because this is the yesterday one. Okay, Thursday one is the left hand side one. Okay, so Friday one is the right hand side one. So basically this one sentiment analysis, what does it mean? It means that you analyze. Actually, this one is called market breadth lah, but to simplify it, okay, I will just call it as the sentiment analysis because you just analyze the market sentiment. Like we will share to our people is that, oh, the loser, meaning the stock price which dropping during the day, we call it loser. Gainer is gainer, loser is loser. Like the gainer, the number of gainer getting lesser during the day. For example, let's say 11 o'clock, 11 a.m. Okay, we see that, okay, the gainer is this much, then the loser is this much, Then around 11:30, okay, you can see that, oh, those active counter, okay, those gainer counter, the gain started to go down. Meaning in the early morning, probably it go up 10%, but probably 1 or 2 hours later in the morning session as well, okay, before the market break. So you can see some profit taking activity coming in. Okay, from 10% gain, it becomes 5% gain. Okay, and the number of loser getting more. Probably in the morning session, 300 loser. Then suddenly it becomes 500 loser. So this is where how we analyze the market sentiment, market breadth, okay, during the day. We can see the market movement, okay, like sometimes the market can be very quiet, we call it quiet, no active counter one, okay, no stop breakout, but those counter not breakdown as well, it's just stagnant, okay. So how are we able to know through the traded volume, through the traded value? I said, morning section, it's only traded this much of volume. It's very little. Okay, so all this is the thing that we can go and analyze. Okay, to know that basically what is happening to the market. Okay, this one also sentiment analysis. This one is I just added one just yesterday after the market hour. So I think might as well I just add in. Okay, so you can see basically the right hand side one is a Friday one. It's very red. Basically, it's like dropping. Everything is dropping because the loser is 1,300. You can see here. Okay, the arrow down, the red color arrow down on the right hand side slide. Okay, the loser is 1,300. Okay, it's considered very panic already, to be honest, because usually bad market sentiment is around 1,000 loser. 1,000 loser. It's considered, like not able to trade actively already. We're going to be more risk averse, but this time it's 1,300. It's basically a lot already. Basically a lot already. Okay, so you can see all these sectors we will see one. Like you can go and every day during the market hours, we can go and see the sectors. We can go and see what is happening to the market breadth, loser, gainer, trader volume, trader value. Okay, market breadth, and we will go and see those sectors. What is the active sector? Like for example, if the construction sector is going out, then we know, okay, probably this counter, the stock in this sector, we can pay attention. Okay, property sector going out, technology going out, plantation, energy. Okay, you can see what is the changes ratio. We can no need to see the number change, you see the percentage change. Okay, so you can find those active sector. Okay, so this one is the we will see also the top gainer list, top volume list, and also those like top turnover list, okay, etc. All these we will see. Like for example, this one is the Thursday one. Okay. You can see basically all those is the active one. Now like the Toyo one, the number 28. Toyo one is the downtrend stock, downtrend rebound stock. Okay, we spotted around 76 cents. 76 cents, then it went up to 80 over cents. So all this is for short-term trading only. You trade, you get profit, you want to exit, you exit. Because no, overall it's a downtrend counter. So unless you want to ride along, meaning you set a cut loss point, cut profit point, then as long as the stock above this range, they will just hold. But we will usually just take a profit already, because this one at first is already the downtrend stock, like we mentioned earlier. Okay, then the number 7, you can see the NTEX. Okay, NTEX, this one is the Thursday one, Thursday top gainer. So you can see in the Friday top gainer got the Jisheng Bar West. Bar West is the gold, one. So market drop, then the gold start coming out. You can see Pokong Tomei also got slight movement, but the Bar West one, the upside is more okay, more active. Okay, and you can see for the index, that's what I mentioned, even though during the Friday crash yesterday, a lot of stock coming down, right, it's still sustained. So it means that be it somebody is supporting or seller is little. Okay, Because if no one support, but no seller, no much seller, so the price wouldn't drop. So this one Friday is still holding there, still holding the price there. Okay, so all these counter, all these thing is the thing that we will see to understand what's happening to the market. Okay, like for example, this one is the Friday one, Friday list. You can see there's no much single stock. Like a lot of it is the we call it structure warrant. Okay, structure warrant. Then if let's say you feel that the market is very bad, they want to hedge along. Okay, later this part the KK another speaker KK he will guide lah. Okay, for the structure warrant part. So basically, you want to hedge along the market. You can focus. Like in this list, you can see that compared to the other slide, there's lesser individual stock, single stock. Most probably just the warrant part, structure warrant. Okay, because the market is not as good. Okay, the one is extremely bad already. Consider. So you can see the list, not much individual stock. Okay, so we have got around 15 minutes. So we will go to the case study that I going to share. Okay, so I will share two of the Hong Kong one. This one is Alibaba. Basically, you can see we can just like simple see. Okay, you can see from the slide there's the downtrend line. So the arrow part is the breakout point. When the stock break above the downtrend line, which is the resistance point that I mentioned. So basically, this point is the point that you should look into. No matter for US stock, Hong Kong stock, Singapore stock also can, but Singapore stock less volatile a bit. It's more for long-term holding for dividend, this and that, Okay. But for US, for Bursa, for those, Hong Kong, we can use the breakout strategy. Okay, for this one, Tencent also. If the downtrend line is longer time frame, like you can see compared to the Alibaba one, this one longer time frame. It means that this price is a very, we call it solid resistance. Okay, means that during earlier period, okay, they try to challenge. Okay, they try to challenge this price, but no matter how, is that they cannot break. But one day it break along the price. So this is the point that we should look into. Okay, and if the resistance is longer, is heavier heavier. If it once it break through, then the momentum will be bigger also. You can compare these two. Compare the Hong Kong stock one. You can compare the outside. Okay, one is the breakout, a shorter time frame, shorter time period of the downtrend line. Another one is the longer time frame, longer downtrend line. So the upside is different. Okay. So for the Bursa one, okay, we will share about the Bursa one. Okay. So this one is the Heli. Okay, you can see we see the volume part first. The volume part, the first green huge volume. This is the volume when the first breakout happened. Okay, but most of the time, like if you are full-time worker, you have to take care of your work, take care of your family, you're not able to buy when it just started breakout, right? So it's okay to miss. Like for this counter, we also miss. But the second arrow, you can see the second arrow that we pointed on the chart. That is the point that we make our entry. We spotted lah. Okay, because like I mentioned just now, for those uptrend counter, even though you see the price already getting higher, right? You see a big bar going up, you will feel scared. You will feel that, oh, maybe I chase high. But I mentioned just now, most of the time it will have healthy retracement. It retrace. When it retrace for the 2-3 days, only you enter. So you can see the volume also. The breakout, it comes with huge volume. When the healthy retracement, it will go with small volume. Okay. Then we can do our entry at the retracement zone. So you can see for the uptrend counter, so everything linked back already. Okay, now you know everything linked back already to the part that we shared earlier. Okay, for those uptrend counter, we focus because whenever it go up, it go down, it will continue go up again. Uptrend. Okay, uptrend steadily going out after retracement. Okay, so it's not like for the uptrend counter, you have to hold forever. As long as you got your profit, you want to earn 10%, 15%, as long as it reaches your targeted profit, you want to exceed, it's okay, no problem. Okay, probably it will go to 20% gain, 30% gain, but it's okay. You get what you want. Okay, so this is one of the example. All this is the real sharing one, is that when the point of breakout, we share one to our own people. Okay, like for this one, a prop. Okay, why that time? For the first breakout, you can see the first solid breakout, it will come with huge volume one. You can see the arrow. Okay, basically is that you can miss. It's okay to miss, but you can see for the next few days, the volume getting lesser. Healthy retracement. The volume getting lesser, and the stop price also retrace. Healthy retracement. Okay, after a few days retracement, then you can see it go up a big bar. And this counter, what the time we will see is because this is called, like, not to say team, but we call the brother sister thingy. It's like it has the related stock. The brother sister is called a related stock. Like it has the related stock is the move in. The move in already steadily going out a lot, percentage wise, a lot percentage already. But this counter never move. Okay, then one day this counter start moving already. Then we know that okay, probably this counter is coming because the related stock of it already been going up a lot, but this counter never move. So this is we call it the related counter thingy lah. Okay, we call it brother sister. Okay, like Theta also linked to HT Padu. It's not to say that fundamentally linked. It's probably we call it a trading style of link. Is that okay? This counter move, then the other counter usually it will move like the EcoWest and NWCT thingy. Related. This is how we trader we spot the momentum. Like this one also Sendai. This one also Sendai also. You can see basically it's the triangle breakout, okay, downtrend line breakout. Basically, you connect the high to high, you connect the low to low. Whenever the stop price choose the direction for you, then we jump in. Save a lot of time. If you buy and wait, we don't know where is the breakout point. Okay, so whenever the stop breaks out, you can see the volume is getting higher. Okay, then you just join along. Then for this Legenda also, you can see, okay, this one I mentioned, like for those bottom catching one, Legenda also, earlier due to the MACC case, it also kind of like limit down. So all this, the one is the bottom catching style, is the other style. Then after it got back up due after the limit down thingy, so the price stagnant at this zone below 1.24 lah, 124. It's stagnant for a while. Then until one day it start break out. Now this is the part that we can monitor. All this is the real sharing that we make one. Okay, so you can see the first arrow zone. This is the point when the first breakout happened. But it's okay to miss. Like I just mentioned, it's okay to miss. You can join when it retraces. Actually, we joined around 1.26, which is two days later. So it's okay to miss because when the first breakout happened, all of us probably working or taking care of family, so it's okay to miss. But as long as this counter start at it, you can look into it. It means that it break out, it chooses a direction for you. So you just wait for it to retrace and you join. Safer. Okay. So this one is the case study that just now I mentioned. We share around 76, 77. Okay. So this one is the downtrend stop. You see the downtrend line, every time it hit the downtrend line, it cannot go up until one day, good volume. You see the volume, green color volume is a lot. It pump out, and like I mentioned, it's okay to miss. You join when it retraces. With low volume. You can see pumping that time, good volume. Retracement that time, healthy volume, small volume, weaker volume. And the stop price also retraces. It's okay to miss. Okay. Like this one, Hascap. You can see the first arrow that I the pointer at the volume part. That is the point when the breakout happens. Solid breakout, it happens with increased volume. Okay, we share in the earlier of the slide. Solid breakout, increased volume. Okay, but it's okay to miss. You can see the yellow color box. That is the point that we joined. We made our entry. So you can see basically, even for us, full-time trader, we can miss also because during the breakout, probably we are not looking at this counter. So we can miss the breakout point entry, but it's okay. We put this counter into our monitor list. We wait for it to retrace. We wait for it to go with small volume, weaker volume, retrace with, some healthy retracement. Then only we consider joining in. Still got profit. Okay? Okay? All this is the real thing that happened. So we are not asking all of you to make entry during the fresh breakout point because it's easy to miss. It's easy to miss, honestly speaking. Okay, so we can put all these active counter into your watch list. Then when you trace, then you join. Okay, so this one is the bar west. Bar west is just now the Friday top gainer. Okay, so this one we didn't make any entry yet because I just put it in to analyze for you all. You can see, okay, basically for the box, for the yellow color box, it means that it breaks out above the box thingy. Okay, the box breakout. Okay, so to be safe, you can wait. It retrace to 49, it retrace to 50 cents, and then you consider an entry. It's not asking like, oh, you see the breakout now 52.5 cents. Okay, then you go and chase. It's okay to miss. Okay, like I mentioned. So you just wait for it to retrace, and then maybe you can reconsider. So if let's say you buy at 49 cents, 50 cents, then you set a cut loss maybe 48 cents. Okay. So if the price drop to 48 cents or below, then you just exit. So depends on how you're gonna control your risk. If you don't want to risk that much, so you can enter 49 cents. So your risk is only 10 cents, sorry. For 49, then you exit 48, okay? 1 cent. 1 cent the risk, okay? So basically it's how you manage your risk. And this one also is a downtrend counter. So downtrend counter, if we rebound, then you want to sell, you can sell. Okay. So basically this is how we see the market movement now. Okay. Okay. It's okay to miss. Okay. So basically this one is antax also, like I mentioned just now. You can see the Friday chart movement. Okay. Even though the market is very panic, but it's still sustained. So probably it's either little seller or a lot buyer tanking the price. Either one. So we can see, okay, the price, the first support 1.26, the second support 1.2. So depends on how you're going to make the entry if you want. So if you think 1.3 over is too high, so you can just wait. You can wait for it to go back, okay, to retrace, slight retracement back to 1.3 and below. And then you maybe want to consider. And this is how we do the simple analysis. Okay. And in deeper analysis, then we will go and check the trading details, market depth, all this buy sell Q movement. We will check all this. But to simplify is that we will focus on the chart movement first. Okay. So all this is the full presentation of the session. So I hope you all learn something. Okay, thank you.
All right, I think we will just keep the Q&A until the end, yeah, because we have got to 11 o'clock. So if any questions are asked our speaker, you may write in the Q&A box, and then we'll attempt to address them towards the end of the session. All right. So let me just take over the
Thank you.
The screen control. Okay, thank you so much, YC, for sharing with us about how do we do breakout trading. So today we have learned so much about breakout trade. And next, we'll have a second speaker from Macquarie Warrants Malaysia to share with you his strategy in trading structured warrants and also stocks using exponential moving averages. So this is about swing trading strategy. You will also learn about what exactly are structured warrants and how you can use it to complement your trading portfolio. So allow me to briefly introduce our speaker today. Our next speaker has been a part of the Macquarie Warrants Malaysia desk since early 2020. Aside from conducting educational seminars and workshops on technical analysis and structured warrants, he is also involved in the issuance, sales, and marketing of structured warrants listed on Bursa Malaysia. He has been involved in the capital market industry for over 15 years, dealing in equities and derivatives listed on both Bursa Malaysia and foreign exchanges. So it's none other than Mr. Kum Kie. So Kum Kie, or we should address you as KK, right? So good morning. How are you today?
Very good, Shane. Good morning to you as well, man. Thank you
All
so
right.
much for the introduction.
All right. Pleasure to have you here today. So without further ado, I will just hand over the control to you.
Thanks. Are you able to see my screen?
Yes, perfect.
Fantastic. All right. Thank you so much, Shane. Good morning to everyone here who are tuning in this morning. I am honored to have this opportunity to speak to all of you today. And thank you so much for your time as well for tuning in on a Saturday. So my topic would be about structured warrants and how you can use them as an addition to in your trading portfolio. All right. So in the next 1 hour or so, you are going to learn about structured warrants and how they can be used in your trading. Plus, I will also be sharing with you a practical strategy to navigate structured warrants based on technical analysis. Right. So I hope you can stay with me throughout the session. More importantly, I hope you will walk away with some valuable knowledge from this session. All right. So let's just get started. Now, before that, it's important for me to address some key points. I would just like to highlight that the presentation materials that we'll be discussing today have not been reviewed by the SC. And additionally, I would also want to emphasize that investment products, including warrants, they carry significant investment risk, including the possible loss of principal invested, and that past performance is not indicative of future performance. All right. Now, on top of that, it's also important to note that the examples that are quoted in this session, they are intended solely for educational and illustrative purposes only, and they should not be taken as recommendations to conclude any transactions. All right. So with that covered, we'll start by gaining some basic understanding of what structured warrants are. Now, I believe some of you may have already attended a basics session by my colleague previously, but for those who are joining in for the first time, let me just quickly cover what are structured warrants and how they function, and how you can make use of these instruments in your own trading. All right. So now, if you have not heard of structured warrants before this, these are actually financial tools or instruments that are issued by investment banks or financial institutions like us that lets you trade an underlying asset at a much lower cost than buying the underlying asset directly. All right. So these structured warrants are traded on the exchange and they follow the performance of their underlying assets. And these assets can include stocks, all right? They can also include indices and ETF, right? Which can be both listed locally and abroad as well, right? So the beauty of structured warrants lies in their ability to offer investors the exposure to these underlying assets at only a small fraction of the actual price, right? So this makes them accessible to a broader range of investors as well. Okay. Now, plus one last point here, structured warrants, they also come with an added benefit of leverage. And unlike other forms of derivatives products, structured warrants, they do not subject investors to margin calls, which means investors, they cannot lose more than their initial investment. Now, you might be wondering why people actually trade these warrants or these instruments, or what are the key attractions from trading structured warrants, right? So the first one would be the gearing, right? One of the main reasons why people trade structured warrants is the gearing that they provide. Warrants are leverage products, meaning that even small movements or small changes in the price of the underlying asset can result in big percentage changes in the price of the warrant, right? In the warrant's value, right? So say, for example, if you have a stock at 1 ringgit and the warrant is at 10 cents, if both were to rise for 1 cent, that would mean a 1% gain in the stock, whereas the warrant would have gained by 10%, right? So this potential for bigger profits or significant profits, it actually makes warrants an attractive choice for investors who are seeking to amplify their returns. Okay. Now, another reason why people trade structured warrants is the fact that they require less initial capital than buying the underlying directly, right? So this makes them accessible to investors with limited capital, right? And it also frees up capital for other investments as well, right? Now, the third reason why people trade structured warrants is the flexibility that structured warrants offer, all right? So because warrants, just now I've mentioned, they can be issued over a variety of underlying assets, such as stock, indices, as well as ETFs, both listed locally and abroad as well. So this gives investors the flexibility in terms of choosing the assets they want to invest in, right? And last but not least, is that warrants gives investors the potential to profit from both bullish and bearish market conditions. Now, unlike other traditional investments that rely on upward price movements, warrants, they allow investors to profit from both price changes in any direction, right? Either upside or the downside, right? So this means that you can adapt to different market conditions and potentially benefit from them as well, right? So with that covered, right, let us just quickly look at the types of warrants that are in the market. So there are basically two different types of structured warrants in the market. The first one is a call warrant. Basically, a call warrant lets you buy the underlying asset, while a put warrant lets you sell the underlying asset. It gives you the right to sell the underlying asset, right? Now, a call warrant is a type of warrant that you want to buy if you think that the underlying asset will go up in price, right? This is because the value of the call warrant will increase as the underlying asset rises. So it goes in the same direction. Okay. Now, on the other hand, if you think an underlying asset will go down in price, then a more suitable structured warrant would be a put warrant. This is because the value of a put warrant will actually increase when the underlying falls. It moves in an opposite direction to the price of the underlying. Right. So by understanding this difference between these call and put warrants, it actually helps you to take advantage of different market conditions. Right. So here are some of the examples of call warrants and some examples of put warrants that is currently available in the market. All right. Now, how you can distinguish or differentiate between calls and put warrants when trading in the market is actually very simple. You just look at the letter after the name of the underlying asset. So in this case here, the underlying asset that I've used is Gamuda, right? And the letter after that, which is this, the letter C actually stands for a call warrant. right? The letter C after the name of the underlying is it represents a call warrant, right? Additionally, the alphanumeric characters that you see after the letter C, that is actually the warrant series, right? It's actually a sort of like a series number where investors get to distinguish between so many Gamura warrants in the market, right? Similarly, for a put warrant, the letter H is used instead of a C. So in this example, you have the underlying Tencent holdings, and the letter H after that shows that this is a put warrant, right? And put warrant is a type of warrant that you want to buy if you have a bearish view on the underlying. It's because the value of a put warrant will go up when the underlying falls, right? Means, say this, for example, this underlying Tencent, when Tencent falls, the value of this put warrant, Tencent H1D, will go up. It moves in an opposite direction to the underlying. Okay, so next, when trading structured warrants, it's actually pretty important for you to firstly understand the key components, right? So in today's short session, I've actually included some of the components which I find important for people to understand, right? The first one is the expiry date. Okay, now basically what does an expiry date mean? It means the date where the warrant expires or ceases to exist. Okay, all structured warrants will have expiry dates. So this makes them more suitable for short-term investments rather than long-term ones. Okay, and for both calls and put warrants, right, the longer the warrant has until its expiry, the more valuable it is. Okay, so the longer it has, the more valuable it is. All right, this is because the longer the time until expiry, it increases the probability of the warrant expiring with value. Okay, now the next term is this exercise price. So exercise price basically it's also another important component. We also call this exercise price as the strike price. So this strike price is the set price at which investors have the right to buy or sell the underlying asset at the expiry date. Okay, so we use this strike price to determine the moneyness of a warrant as well, which can fall into three different categories: in the money, at the money, and out of the money. Right now, besides that, this strike price is also very important in determining the value of a warrant. So a call warrant with a higher strike price. So let's say a call warrant with a higher strike price. Okay, a call warrant with a higher strike price is usually less valuable because it is less likely to expire with value. Whereas if the call warrant has a lower strike price, it is more valuable because it is more likely to expire with value. Now, the opposite applies for puts. So a put warrant with a higher strike price, put warrant with a higher strike price is less likely. Is more likely to expire with value. That's why it will be more valuable. Okay, so other than the first two terms, right, that you see earlier, we also have the exercise ratio. So basically what this exercise ratio means is the number of warrants that is needed to exchange for 1 unit of the underlying at expiry. So for instance, if you see a warrant with an exercise ratio of 10:1, for example, so this means 10 warrants are needed to exchange for 1 unit of the underlying at expiry. Okay, and this structure and this exercise ratio, it also affects how sensitive a warrant is to changes in the price of the mother share. So meaning it determines how much the price of the mother share will need to move for a one tick movement in the warrant price. Okay, so warrants with a smaller exercise ratio, they tend to be more sensitive, but also they will have a higher warrant price. Right? On the other hand, warrants with a lower exercise ratio, they tend to be less sensitive, but they will also be lower in terms of absolute warrant price. All right. The last term that I have for today is the effective gearing here. So basically, the effective gearing measures how much the warrant price will change in response to a 1% change in the price of the mother share. So say, for example, you have a warrant with effective gearing of 5 times. So this means that if the mother share go up by 1%, the call warrant will move by approximately 5%. Okay? So if a warrant has an effective gearing of 10 times, it means that for every 1% change in the price of the underlying or the mother share, it will result in a 10% change in the warrant price. So basically, if you understand the effective gearing, it helps you assess the potential risk and rewards for trading that warrant. Okay, higher effective gearing will mean a bigger movement in the warrant, and also it converts to a higher profit potential. But also the level of risk will be higher as well. Okay, so it's always important for investors to understand their own risk tolerance and find a right balance between the potential gains that they are looking to gain from the warrant, as well as the risks that they can accept. All right. So those are some of the key important terms that I have for today's short session. The next one, let us move to how you can choose a warrant that suits your strategy. Right. So basically, here I have simplified the warrant selection process into just 4 simple steps to help you select a warrant. So the first step here is to take a view on the underlying. So take a view on the underlying, meaning you will need to decide whether to go long or go short, right? Or because the first step is to decide whether to go long or go short, and then after deciding that, you will be able to this will be able to guide your decision whether to buy a call or a put warrant. Okay. Now the second step is to basically set a trading time frame. So some of the questions that you can ask in this step is perhaps how long do you think that the underlying will take to move towards its target? Or maybe how long do you plan to hold the warrant for? Okay, and based on that information, you can select a suitable expiry date to trade. All right. Now, after that, you have to look at the effective gearing level. Now, what I say just now, you will have to find a right balance between the risk and return. Now, in this case, say for example, you have a bunch of warrants with the same terms. So you will want, if let's say you are a more conservative investor, you may want to choose a warrant that perhaps has a relatively lower effective gearing level, right? Whereas more aggressive investors, they may consider something with a relatively higher effective gearing level. So it all boils down to your risk tolerance. Okay, and the last step is to ensure that the warrant is liquid. So here you need to look at the liquidity of a warrant, and this liquidity actually determines how easily you can enter and exit the warrant. Okay, now some of the key things that you want to look out for, right, in this step number 4 is this. Now, so some of the key things you want to look out for when considering liquidity of the warrant, right, is actually to look out for the bid and ask volume for the warrant. And secondly, is to look at the bid and ask spread. So now here I have an example, right? Because many people, they mistakenly assume that a warrant with higher traded volume, like this, they often mistaken a warrant with a high traded volume. They will say that it has high liquidity, right? While this might be the case for stocks, it may not really be the case for warrants, right? So in order to compare the liquidity of a warrant, right, you actually have to look at two different things, which is the bid and ask volume, as well as the bid and ask spread. Okay, so bid and ask volume is basically the quantity for the warrant on the bid and ask. And the bid and ask spread is the distance between the price, the bid price and the ask price. All right. So bid and ask volume, you want to look at as high as possible. You want it to be as high as possible. Right. Anything that has at least 500,000 units is good. Is a good start. Right. You also want to ensure that the bid and ask spread is on tight spread. Tight spread meaning that the distance between this bid and an ask price, right, is actually one tick apart. It's only one tick apart. You don't want to be buying into a warrant that is on a wide spread, because this will increase your cost of trading the warrant, right? So with that said, right, if you look at this image, maybe I erase it again. So with that said, if you look at this image, there are two different warrants, warrant X and warrant Y. So while you may notice warrant Y has a higher traded volume, if you look closely, the warrant is actually trading on a wide spread. If you notice here, the bid price is actually trading at 12.5 cents, whereas the ask price is 13.5 cents. So there's a gap in between. So this warrant is actually trading on wide spread. Plus, the bid and ask volume is actually pretty low as compared to warrant X. Because warrant X, even though the traded volume is low, you can see that the bid and ask volume is actually very thick. And the bid and ask price is actually trading at a tight spread. So in terms of liquidity, warrant X will be a better choice in terms of liquidity, right? So this is how you can compare the liquidity of a warrant when you trade structured warrants in the market. You want to go for something that has a relatively higher, relatively liquid, right? So next is the section where I will be sharing you a method or a strategy where you can use just two indicators to trade. Right now, before we move on, right, I like to emphasize that these are not recommendations to buy or sell any security, and the examples are intended solely for educational purposes only. All right, so basically, the strategy that I'm about to show you is based on a trend continuation pattern, or in other words, trend trading. Right, so it's actually very simple, and it only uses two different exponential moving averages. Okay, so you may experiment with this strategy and see what works best for you. You may also incorporate it into your existing strategy, right? And feel free to backtest it and add it into your existing strategy if you feel fit, right? So basically, what I've mentioned just now, you only need two different indicators, which is the 8-period exponential moving average and the 50-period exponential moving average. You can actually see this on the chart. The 8-period is the pink line, whereas the blue line is the 50-period, right? So I've broken down into a step-by-step process, which you can easily follow. All right, so basically, step number one, the conditions, is to have the 8 on top of the 50. So in this case, if you see here, when the 8 is on top of the 50, the trend for the stock is in an uptrend. Right, we call it an uptrend. Step number two is to ensure that both the exponential moving averages are separated apart. Right, now you can see here, there's actually some distance between the two exponential moving averages. So whenever there's distance, it shows that the trend is strong. right? You don't want the moving averages to crisscross between each other, because when it crisscrosses, it is in a sideways mode. Okay, so that's step number 2. You want to make sure that they are well separated. Step number 3 is to look for pullbacks towards the, maybe I delete my drawings first so that it doesn't cloud your view. Okay, the next step, right? Step number 3 is that you want to ensure the candles pull back only towards the 8-period moving average, right? To form a flag pattern. Now, if you see here, step number 3, right? The candles, they are actually pulling back towards the 8-period to form a small flag pattern, right? Here as well. Step number 3, form a flag pattern, right? Now, I mentioned here to pull back only to 8-period moving average. I will answer why in the later slides, right? There's a reason why we want it to only pull back towards the 8-period EMA, right? To form a flag pattern, okay? And step number 4 is to wait for a flag breakout. Let me erase this. Okay, so step number 4, maybe I highlight in blue color, easier. So step number 4 is to wait for a breakout of this flag pattern. Okay, breakout of this flag pattern. Okay, so to illustrate further, right, for more insight on how this strategy works, right, let us look at some case study examples. So this here is a stock, Mr. DIY. So the same 4-step process applies to the chart, right? So the first step, you want to make sure that the 8 is above the 50. Now you notice if the 8 crisscrosses the 50 line, right, which you see here, the trend is actually sideways. Sideways means no direction, right? And the whole system, the whole idea for this system is for trend trading, is to trade trend continuation patterns. And whenever the 8 crisscrosses the 50, right, there is basically no trend. So it's sideways, basically no trend. So there is just no signal. Okay, so what you want to do, right, is to have the 8 above the 50 to confirm a trend first. Okay, step number 2 is to make sure that they are separated or start separating. You want to have like a sort of like a cushion for price to stay cushioned, you know, because once the EMAs, right, are separated, this area serves like a pillow or like a cushion for price to sit back, for price to retrace. Okay, so that's why we want to have something sort of like a cushion, so that price can get supported at that band. Okay, so step number 2, to make sure that they are well separated. Step number 3 is to ensure that the candles, they consolidate back towards the 8-period EMA. 8-period EMA. Okay, whereas step number 4 is to wait for a breakout of the consolidation. Okay, so if you want to trade these type of patterns, right? Now in this scenario, right, if you want to trade this setup, there are a couple of options for trading this breakout. One option is to trade the underlying stock itself. However, if you feel that maybe the stock is too expensive or you have a small trading account yourself, you can actually trade it through a call warrant instead. All right. Now, you recall earlier when I said call warrants, they actually move in the same direction as the underlying. So this chart actually shows or illustrates that whenever the underlying price goes up, the warrant will actually follow. The call warrant will actually follow. So here, the bid price, here this is the brown color is the price of a warrant, whereas the blue color is the price of the underlying. You would notice that whenever the underlying goes up, the call warrant will go up as well. Right? And if you compare the performance, if you compare the performance between the mother share, this is your mother share, and the warrant, you can see that within just a period of 2 days, the mother share would have gained by 9.2%, whereas the call warrant, Mr. DIY C28 would have gained by more than 55% within the same period. right? So this highlights the potential returns for the warrant, right? So this is how you can trade the upside by using a call warrant, right? Because structured warrants, they magnify the price movements of the underlying, right? Now, another example I have here is Hanwei. Just the same four-step process apply, right? Four-step process. First step is to have the 8 above the 50. Second step is to have them separated. Third step, you want to see consolidation patterns back towards the 8-period exponential moving average. Okay, so here you can see the price they actually consolidate towards the 8-period. Now, in fact, here as well. So it didn't really go back down towards the 50 at all. So the 8-period exponential moving average, right? It supports the price really, really well. Okay, so the step number 3, your job is to ensure that it consolidates towards the 8 to form like a flag pattern. And whereas the last step is step number 4 is to wait for a breakout of this pattern. Right now, you can see here in this chart, the stock actually went up by more than, I think, 24%, okay, upon breaking out, right? Now, if you compare the performance of the underlying stock and the warrant, you will see that within a 21-day period, which is around 3 weeks, the underlying would have gained by 24.6%, whereas the whereas the call warrant would have gained by 134.5% at the same time. Right? So this is how, and this is why people trade structured warrants. And one of the reasons why people trade structured warrants, which is the gearing effect. Because structured warrants, they amplify the price movements of the underlying asset. Okay? Now, I have many different case studies here, just like YC. It's just the same setup repeated over and over again. Now, recall earlier, I've said, step number 3. Step number 3 just now, we want the price to consolidate towards the 8-period EMA, right? There's a reason why. Okay? Now, the whole reason, right, now because we are trading a trend continuation pattern, right, and we are looking for momentum setups, right? And when you want momentum, right, we do not want the price to consolidate deep. So whenever it consolidates below the 8-period EMA, right, like here, it went below the 8-period EMA, that is considered a deep pullback, right? So what our whole objective is to want price to be supported at the 8-period EMA because we want shallow pullbacks, okay? So setups such as this, when you see the candles penetrate the 8-period EMA, right, that doesn't signal a valid entry because it went below the 8-period EMA. So you want them to be cushioned on top of the 8-period EMA, such as here. It stays supported at the 8-period. So which is why which shows that momentum is still there, right? Because the pullback isn't that deep. So that's the whole point of the setup. Okay. Now, if you compare the movements of this underlying massing, you can see that within a 3 days period, the mother share would have actually gained by 17.8%. Whereas if you will have to bought the warrant, it would have gained by 68.8% within the same period, 3 days. Okay. Now, yes, of course, here, another example on the Nikkei futures, you would see here 8 above the 50, right? And it's starting to separate. Third step, the candles actually move near towards the 8-period EMA. And step number 4 is to wait for a breakout. Okay, when it breaks out, I think the price of this underlying, I think the underlying actually went up by 6.8%. All right, you can actually see many different setups here forming as well. So this strategy is actually very simple and it can be repeated for different many different underlines and different time frames as well. Okay, so just to illustrate the percentage gains between the underlying versus the warrant, you can see that the futures that I've shown you in the picture just now, within a 10-day period, futures has actually went up by 6.8%, whereas the call warrant Nikkei CD have gone up by 95.7% within the same period. Right? So now those examples, right, that I've shown you were on the day chart. Okay, you can also replicate the same thing on the intraday charts, such as the hourly chart, 50-minute chart, 5-minute chart, even 1-minute chart. Right? Now this example here is an example using the weekly chart. Weekly chart. Okay, so here you will see that the weekly chart prices, they actually consolidate towards the 8 period. You can see it here as well, towards the 8 period. Here as well, towards the 8 period. Right? And when it broke out close to a 1-month period, the mother share actually went up by 30.8%, whereas the call warrant would have gained by 130.8% within the same period. Right? Now, one thing maybe I can share with you one tip here. Now, if you notice carefully, right, this area, you can actually see that prices are consolidating tighter. Okay, if I replicate this movement, right, you will see that I have this trend line here. You will see two different loops, the first loop and the second loop. So this looks like a cup and handle pattern, right? So the tighter the consolidation, you will see here, the first loop, right, prices actually pull back deep, and then it didn't really get to penetrate the resistance here, the previous high, and then it consolidate again. And if you compare loop number 2, this second loop versus the first loop, you will see that loop number 2 is actually very shallow. It gets shallower and shallower. That means that the sellers are actually drying up, right? And whenever it breaks out, that would usually subsequently you will usually see a stronger breakout as the pattern consolidates tighter and tighter, right? So the whole idea is to look out for tight consolidation. Okay, and then the whole idea actually, if you look back on previous examples, actually whenever you see stuff like this, when it consolidates very tightly, right, it means that the selling pressure is actually very, very weak, right? And buying pressure is there. So this actually adds up to the momentum as well. You can see here as well. So whenever it consolidates tightly, right, the breakout, I mean, there's a signal where the breakout would come very soon. Okay. Now, maybe one last example on the upside. Now here is also on the weekly chart, where you see the consolidation is actually very tight and it's actually supported or it's cushioned at the 8 period EMA. So whenever when it broke out, the stock has actually rallied by 31%, whereas the call warrant would have gained by 276.5% within the same period. Right, this is more towards the swing trade because it's using a weekly chart. And this is how you can use the strategy, right? And you see here, in this example and this part, candles that are actually broken down below the 8 period EMA. So that is not the condition for this setup because it has pulled back very deeply. So what we want to do is to look for shallow pullbacks. Right? Now, if you can do this on the upside, you can also do this on the downside as well. So basically, you just flip the conditions on the opposite side. So which means your step number 1 is terbalik. So 8 period EMA must be below the 50 now, right? And other conditions remain the same. You want the moving average to be separated. You also want the candle to pull back towards the 8 period. All right. And the last step is to wait for a breakout of this consolidation or flag pattern. All right. Now, if you see here, right, just now I share with you, you have your support level. Your first loop is this. Your second loop is this. This is an inverse cup and handle. So inverse cup and handle, it means that the first loop, buyers can easily lift the price up. It can rebound. Whereas the second loop, it is weaker already, which means the buyers are getting a harder time to lift price up, which means selling pressure is increasing. Right? So this is how you can compare two different loops. And that is the psychology behind a cup and handle pattern, whereby prices consolidating tighter and tighter before a breakout, a breakdown in this case. Right? So to highlight the example, just now I mentioned you can use for other time frames as well. Here we have the 15-minute time frame on the Hang Seng futures, where you see the 8 period below the 50 period. You can also see that they started to separate. That one is to see consolidation towards the 8 period EMA, whereas the fourth step is the breakdown or breakout. All right. So in this case, just within a few hours period on the same day, 15 minutes chart, right? So the underlying has actually went down by 1.2%, whereas the put warrant would have gone up by 11.1% within the same period. So this is how you can trade the downside by using put warrants, right? Especially in the past few days, you will see very bearish market conditions. So put warrants, they actually allow you to trade bearish market conditions. Okay, so here another example as well on the stock HKEX. It's just the same setup repeated over and over again. So here you can see the underlying has actually went down by 6%, whereas the put warrant would have gained by 37.5% within the same period. All right. So now, with that said, right, while structured warrants, they offer various opportunities, it's very important to recognize that they also come with risks. Right. So, and it's important for you to understand the risks involved with trading structured warrants. Right. Now, one of the key risks is the market risk, which is the risk that the underlying asset goes against you. So this can happen for many different reasons. Maybe economic news, economic factors, natural disasters, stuff like that. Okay. So that is one of the risks. You also have exchange rate risk, which is true for warrants that are for warrants over foreign underlyings. So this risk is the risk where the price of the structured warrant is affected by changes in the exchange rate between the currencies of the underlying asset and the currency where the warrant is traded in. Okay. Another one is the gearing or leverage risk. All right. Now this is because structured warrants, they offer leverage, right? So which means that they can amplify the price movements of the underlying asset. Bear in mind, this can be a double-edged sword, right? It can be a good thing if the underlying price moves in your favor. Can also be a bad thing if it moves against you, right? Because the potential losses will be magnified as well, right? And last but not least is the fact that structured warrants have limited life. Right, unlike some other investment products which have a limited lifespan, right? Structured warrants, they have a predetermined expiry date. So investors must be aware of this and factor it into their trading strategies. All right. So just want to highlight that while I have mentioned some of the risks associated with trading structured warrants, it is also important to highlight or emphasize that this list is not exhaustive. So for more information about the risks associated with trading structured warrants, we actually encourage you to refer to the base prospectus, which is available on our website, malaysiawarrants.com.my. Right. Now, with that said, let me just quickly bring you through to some of the offerings that Macquarie currently has. Right now, we currently provide warrants over various underlying assets, including Malaysia stocks, the FTSE KLCI, the KLCI index. Right. So, and if you are interested in trading the US indices, we also offer warrants over the S&P index, Dow Jones, as well as the NASDAQ. Right. And for those who are eyeing the Hong Kong markets, we have warrants over the Hong Kong stocks, Hang Seng Index, Hang Seng Tech Index, the A50 ETF, China A50 ETF, as well as the new product that we have is the Gold Trust, right? It's 2840HK stock code, all right? Which is this GLDHK, all right? Other than that, we also have warrants over the Nikkei 225 index, right? Which you can see labeled as Nikkei, right? In under Bursa Malaysia. Okay, you can easily trade these warrants to your existing stock account. There's no special account needed. And if you're uncertain about any of these products, do feel free to give us a call, right? And we'll be happy to address your inquiries. All right. So other than that, other than the products that we have, we also have tools for you to trade structured warrants. The one that you're looking here is actually the Live Matrix tool. This is actually a page that is directly connected to our market making system. And it actually shows you where the warrant will be trading at when the mother share trades at a certain price point. So say, for example, if you are trading this Genting C3A, or sorry, maybe you are trading the Hang Seng, right? It actually tells you where the warrant will be trading at when the underlying moves to certain price areas, right? Besides that, we also have many different indicators on the Live Matrix tool. You can actually see that it actually indicates when a warrant is sold out, or when a warrant has a low time decay, when it has a high liquidity, etc. Okay, so this is the Live Matrix page. You also have we have the live warrant search page as well. So this helps you easily filter out the warrants based on all the criteria that you want to look at. Maybe the time frame, effective gearing, call or put, the moneyness, and so on, so forth. Okay, and these tools are all available for free on our website, malaysiawarrants.com.my. All right. For newbie investors or newer investors, or who are who want to quickly look at trends of a certain underlying, we actually have another tool which is called the warrant heat map tool. So this basically shows you the trend or the momentum of a certain underlying, and it is actually available on our website for free, right? So these are all based off of these Trade VSA's proprietary indicators. It also has charts that are included, that are labeled with Trade VSA's proprietary indicators. So this shows you a trend and the momentum of a certain underlying. It also shows you Macquarie's associated warrants for that particular underlying, if you click on this name of the underlying. Okay, so this is our website, right? malaysiawarrants.com.my. So do feel free to check it out. All right, we have many different tools here. All the tools are labeled here. You can just toggle it at the top part, right? And if you have not followed us already on Telegram, you can do so. You can search for Malaysia Warrants on Telegram, or you can scan the QR code here. We share a lot of educational information about structured warrants, such as research reports. We have market colors, educational materials, and etc. Right, so do follow us. Remember to follow us if you have not. And with that, I would like to thank you for your time spent with me today. Hope you learned something new today as well. All right, thank you so much. Shane, back to you.
Thank you so much, Kum Kie or KK, for sharing with us how do we use structured warrants to complement our trading strategies, and as well as sharing with us, what is your strategy, which is the EMA 8 and EMA 50, right? So we have learned this strategy from Kum Kie. So if any question to ask KK or ask YC about their sharing, please write your question in the Q&A box. Yeah. Okay, we have seen the first question, which is from Ramzam. If we want to trade structural warrants, how do we trade? Do we need to register? KK? You're on mute.
Sorry. sorry. May I? What was the question again?
If I want to trade
Okay.
structural warrants, do I need to register somewhere? How do I trade?
Oh, okay. It's actually very simple. If you want to trade structured warrants, it's actually very simple. You can just, all you need to do is to open a brokerage account with any brokerages in Malaysia that offer trading in KLCI, the FBM KLCI stock. So it uses the same CDS account where you trade stocks as well. So it's very simple to open an account. You just have to visit a brokerage house and you just inquire.
All right. So the next question is by Badru alias. If the warrant expires in the money, can I get a cash settlement?
Yes. Yes, correct. If you hold the warrant until expiry, right, and for example, if it expires in the money, then you will get a cash settlement either via a check or internet transfer, right? So if let's say it's in the money, right, the cash settlement will actually be transferred out within 7 days from the expiry date. Whereas if it's a check, then you will receive it via a normal post.
Thanks, KK.
Yep.
The next question is, what is the advisable holding period for structured warrants? So this is a question by Robert Tiang.
Oh, thanks, Robert. So basically, the holding period, right? It actually depends on the individual itself. Different people will trade warrants using different time frames. So if you are more of a swing trader, you may want to hold the warrant. See, depending on your strategy. If it's swing trading, most likely you will be holding it slightly longer period. But in general, right, because structured warrants have expiry dates tied to them, right, it is more shorter term. You cannot hold it for too long, not like stocks or anything. So I would say let's say you want to trade a momentum move, and whenever that momentum reaches your target, right, that would be a good time to what it's all shorter term bias.
All right. Thanks, KK. How about gearing ratio? Do you have any recommended gearing ratio for us to consider?
Okay. For gearing, right, it actually depends on your risk tolerance. For more conservative investors, right, most of the time, we encourage you to look at the effective gearing data. So you want to select something that has a relatively lower effective gearing ratio if you are a more conservative investor. So people who are more, gung-ho and they can take more risk, right, then they might consider something that has a higher effective gearing. Because that effective gearing is the measure of risk. So it all depends on that individual, whether he's able to take on the risk or not.
I see. So I see a follow-up question by Esther. Having talked about effective gearing, right? So between sensitivity and effective gearing, which is more important?
Okay, sensitivity, right? If let's say you are more shorter term trader, you do intraday trading or maybe contra, buy today, sell tomorrow type of thing. Maybe you want to look at the sensitivity lah. So, but in general, we usually look at the effective gearing. Yep.
Okay, thanks KK for sharing your perspective. The next question, are the brokerage costs and clearing fee lower if we trade structured warrants?
I'm not really sure on that. Maybe we have to check with the brokerage account. I haven't been looking at that. So yeah, apologies for that. I couldn't be able to answer.
As of now, is the stamp
The-
duty still waived?
Yeah. No, it's not waived anymore. Yeah, that I know.
Right.
Yeah.
So check with your broker, okay? I think clearing fee is definitely the same, 0.03%
Correct.
of
And
contract
stamp duty
value.
there is as well.
Yeah.
On the brokerage cost, right? That I think it varies between brokers. So probably we might have to check with that broker.
So just now you mentioned about cash settlement when it expired in the money. So the next question is, do I need to make any applications to receive the cash settlement?
Oh, okay. So let's say you hold the warrant until expiry, right? You do not need to do any single thing, and everything will be done by the issuer. You don't have to apply. You don't. There's no special application for you to do. It's all, even the cost as well. It is all. I mean, for us lah, as the issuer, Macquarie will bear all the settlement cost as well lah. So the investors do not need to do anything. There's no action on for investors.
Yeah. So I think the idea we get from KK is that if the warrant expire in the money, that's where we can hold until expiry lah. So if the warrant expire out of money, I think you better quickly
Yeah. No, if it's out of
sell
the
off
money, right,
first.
then yeah, there will be no cash settlement at all. So it's yeah.
Because the closer it is to expiry date, the time decay of the warrant is very steep. Correct. So the next question is from Suhaidi. So can you talk about warrants that start with the code W?
Oh, I think Suhaidi means company warrants. Okay, because I'm the ones that I do here are structured warrants. I really cannot comment on company warrants. So I mean there is a difference lah. I can only tell you, the key differences between the two. So normally company warrants, right, they are issued by the company itself as a means to raise capital. Whereas for structured warrants, right, it is issued as a trading instrument for investors to trade. All right, so the terms, if you compare the expiry dates, the expiry period, right, you will notice also that company warrants, they are much longer dated. They go in years, right? Whereas structured warrants, they are usually within a year. All right, 6 months, few months. So it's more shorter term. And another key thing that you can note between the difference, the difference between the two is the presence of a market maker. So for company warrants, right, there are no market makers. Whereas for company warrants, whereas for structured warrants, there's the presence or an entity, which is the market maker, which provides liquidity for investors to enter and exit the market. So they put in the price as well as the quantity for investors to trade easily.
All right. Thanks, KK. I think let's pose one question to YC. PY would like to ask, may I know what app or brokerage offers software or tracking the buy and sell breakout instead of manual monitoring? Do you know?
Usually for us, we still use the trading view to filter the stock for ourselves. Well, for the software tracking the buy and sell breakout, usually is that like the trader, they set up their own indicator through the trading view as well. So whenever the stock breaks out, they will send an alert to themselves. So that one is the self-create one. But usually for us, we still need to manually go and screen, just that the screener itself already help us to filter a lot of stock already. Let's say 1,000 over stock in Bursa, then we filter those momentum stock, probably less than 100 left. Then you can set more criteria to that. So probably less than 50, then you just look into the 50 stocks. So cannot be like 100% based on the software, but we can say it's a combination of it.
All right. Thanks, YC. So let's pose the next question to KK. Are there any scenarios or possibility whereby the mother share goes up but the warrant's not moving?
Yeah, maybe when it's very close to expiry, maybe few days left and it's far out of the money, right? So it takes a very big movement in the market share for the warrant to only move a little bit. So that's one of the scenario lah. So other things that uh others are maybe include like maybe the quotes are not in or something technical error or stuff like that lah. But usually they track one. Yeah, it's only about whether it's very far out of the money and very near to expiry, right? Then sometimes you will see that even the mother share moves, it's not enough it's not enough for that warrant to move by one tick. So it takes even more for that underlying to move just for that, small movement in the warrant.
I see. The next question is by Masniza. Do we need to buy the mother share first if we want to buy the warrant, or we can directly buy the warrant?
Oh, okay. So actually, no. If you want to, because warrants, right, is just like instrument which lets you trade the mother share for a small fraction of the actual value of the mother share. So if you want to trade the mother share, right, and then say for example you don't if it's too expensive for you, you can actually trade it with a call warrant. You don't need to buy it, simultaneously, because when you buy the warrant, it actually gives you exposure towards to the underlying. Yeah. And just now when I mentioned on the charts, right, something I want to add is when I look at the charts, right, you want to look at the chart of the mother share instead of the warrant, because some warrants, right, they might not be traded actively every day. So it's good to look at the charts on the mother share and to determine, the levels you want to, the breakout levels and stuff. You don't look at the warrant chart. You look at the mother share chart.
All right. Thanks, KK. There are still a lot of questions on warrants. I think maybe we'll just extend for another few minutes, yeah, because it's noontime. I know many of you here are starving, probably starving. Yes, the next question is, before the expiry, do we need to make consideration of the moneyness, especially the out of the money warrants?
Yeah, so you would need to monitor it closely because towards expiration, right, the time decay would usually be very steep. So the higher your risk, if let's say if it's very far out of money, right, that's the higher your risk of holding it. So another thing you want to look at, right, if let's say you trade a warrant, basically people use it to trade in the short term, and very seldom people hold it until expiry. But if you want to hold it expiry, right, you will have to closely monitor, especially if it's out of the money and then it's nearing expiry. So that you will need to monitor because the time decay would actually be very steep towards expiry, and you will need the market share to increase even more just for the warrant to move. All right.
All right. So the next question is by PY. Is it true that the percentage gain may be big for warrants, but the absolute gain or loss may be small, given that the price of the warrant is low?
Let me process. I couldn't understand. Let me have a look. Now
I think
based
what
on
he
sorry, Shane.
I think what he means is that if the percentage could be big, right? Maybe you make 100%, 200%, 300%, but then the actual gain could be small because the price is very low. But actually, I think it depends on how many quantity you want to buy, right?
Yeah,
If
correct.
you want to get that kind of exposure, absolute gain that meets your target profit, then you need to buy more.
Yes, correct. So you have to look at the effective gearing as well, lah, because if you buy more, right, definitely the exposure will be more. So it all depends on the risk appetite.
Yes. All right. We have one participant who want to ask you, can you issue call and put warrants for US stocks?
Um, we thanks for the feedback. We can look to that. Thanks for the feedback. We will look to that. Yeah, might consider.
All right. So the next question is by Esther. When it comes to live matrix, do we need to view the structural warrants with real-time data? If yes, how do we get the real-time live matrix data?
Our live matrix page, right? It is all live. So it is based on the price movements of the mother share. So you just have to, I mean, when you register for a brokerage account, right, you would have already got the market data for the mother share, right? So that live matrix is actually live. The prices there are actually live. So it will show you where the warrant will be moving to when the mother share move to a certain, level. Yeah, it's actually live.
All right. So the live matrix on Macquarie website is live, yeah?
Correct.
Live
For the stocks.
Yeah.
Yep.
MalaysiaWarrants.com.my. All right. So looks like we have addressed most questions. So there are still some questions on my panel, but we have overrun the session by 5 minutes. So I guess it is time for us to wrap up the session. So thank you everybody for tuning into this session that is organized by our company and is in collaboration with Macquarie. So thank you so much YC for coming to speak on this event. Thank you so much KK for sharing with us about warrants and your trading strategy in swing. All right. So have a great rest of the weekend, everybody. So hope to see you in our next warrant webinar with Macquarie. Okay, there's still one more in Q4, so we'll keep you posted. All right. So bye bye, everybody. Have a great weekend.
Thank you.
Thanks,
Bye-bye.
KK. Thanks, YC.
Bro.
Bye.